On Hot Picks today, we are focusing on U.S. financials. Our guest has Citigroup as his top selection. He says it's likely to benefit from several trends in banking, including expense efficiencies driven by AI. We are joined by Mike Clare, Senior VP and Senior Portfolio Manager at Brompton Funds. Mike, thanks very much indeed for joining us.
Yeah, thanks for having me.
Citi is catching your eye these days. What attracts you there?
Yeah, so Citi's been our number one pick in the banking sector for the better part of the last year, and we still think that they have pretty strong momentum into next year as well, capitalizing on the three key trends we see in the space. Number one being regulatory relief. We're also bullish on the capital market cycle, which is about 30% of their business, and of course, expense management. On the regulatory side, Citi sits on about $16 billion of excess capital currently, but we should see in the first half of next year, we should see some pretty tangible things coming out of the U.S. administration on the regulatory side for banks. Number one being reform of the GSIB surcharge, which affects the capital levels for the largest banks in the U.S., as well as we should see finalization of the Basel III endgame rule that we expect to come out next year as well. For Citi, that means they could double their excess capital levels. And we expect them to buy back a lot of stock. They bought back about 2.5% of their stock in the third quarter alone. We could see them buy upwards of 10% of their stock through the end of next year. And notably because they traded at a discount to other banks out there, trading around book value now. They can do that on an accretive basis for their shareholders.
It looks like there's been quite a spike in Citi lately, Mike. It looks like investors are buying into the thesis here.
Yeah, I think that the market's starting to catch on. They had, they're looking at, they've been an underperformer on the return side. They've had a target of, 10 to 11% return on tangible common equity for 2026. It looks like they're going to hit that. They announced it in Investor Day for May 2026, where they should come out with new targets. So we think they should, be able to do better than expected, raise guidance, even with consensus numbers out there having them growing earnings per share by over 30% in 2026 alone. So we think there's potentially upside there.
So the return on Citi over 5 years, about 135%, not bad, beating the financial index. But Morgan Stanley's been a charm to own. People have trebled their money in the past 5 years, including dividends. But you see more upside.
Yeah, we still see upside across the capital market space. Morgan Stanley in particular has built a very strong equities business, and they've done very well on the trading side. But we're just actually starting to see an uptick in investment banking revenues, which is really their bread and butter. Investment banking, capital markets overall, up until the last couple of quarters, has really gone through quite a bit of a downturn with M&A activity running something like 30 to 40% below long-term averages, ECM activity running more like 50% below long-term averages. That's just started to tick higher. Of course, there's lots of talk out there about potentially some big IPOs for next year, the likes of OpenAI, Perplexity, potentially some others, right? So Morgan Stanley has a very strong technology franchise in particular, very strong equities business, and we expect them to be in the game on a number of those deals. Just to give you a sense of some of the numbers, in their most recent quarter, Q3, investment banking revenues were up something like 44% year over year. ECM alone up 80% year over year. And we think that momentum really continues into 2026, and there's potentially more upside to consensus as they continue to perform well.
And then finally, Citizens Financial has caught your eye. What's the attraction here? What do they do?
Yeah, so Citizens Financial is one of the regional banks. We do like not just the large cap banks. We like regional banks or some of the higher quality regional banks heading into 2026. So this is your typical retail and commercial bank operating in New England, the Mid-Atlantic, and Midwest regions. But what we really like about it is there's pretty strong visibility in terms of returns improvement into the next couple of years. So they're currently operating around 11% return on tangible equity. We think there's pretty strong visibility to improving that number to 15% over the next 18 to 24 months, just given some lower yielding assets roll off and they can reinvest in higher yielding assets given that rates have moved higher over the past couple of years. They've also done a really good job. They've been focusing on building out a private bank, which targets high net worth investors. And that's starting to have a big impact on results as well, impacting earnings by about 7% this year. That could grow to 10% next year and potentially doubles longer term. And then on the capital side, Citizens, relative to its regional peers, has one of the highest capital requirements. These smaller banks only participate in the stress test every 2 years, so they didn't participate in 2025. So when they do participate next year in 26, we expect to see a decline in that number similar to some of their peers. And ultimately, they'll have excess capital, which they can either deploy into the business to grow the private bank or to put into buybacks. And again, this is a company that's growing earnings, something like 30% plus in 2026 and potentially another 20% plus in 2027, trades at 12 times earnings, which is just too cheap given the fundamentals. So it's a stock we really like here.
Mike, thank you very much indeed.
Thanks for your time.
Mike Clare, Senior VP, Senior Portfolio Manager at Brompton Funds.